Happy Saturday and welcome to another episode of RM Smart Investing's weekly market analysis. I hope you're all having a wonderful weekend. It was a crucial week, and I believe we are in some kind of inflection point. I think next week will give us more clarity, but last week was an important week, and there are the few points I'm going to go over. So we will review those to see what this coming week, and I would say that will give us a guidance for the month, and we'll see if seasonality will go to end the year on a strong note or not. But it is something I would definitely pay attention to the markets this week. So as always, we look at the economy, the markets, emerging markets, lesson of the week, trade of the week, and the screen of the week. So if anything, if you have only 5 minutes, this is what I will recommend to pay attention to. So there's few things we're going to emphasize this week. And I think, as I mentioned, they're going to give us the guidance about coming weeks. Obviously, the number one, we had the FOMC. There was no surprise, as you know, the markets were really counting on no rate changes, no increases, but the language was the important part, and they reacted to that, especially the part that the Fed thinks that the economy is still strong enough, and it does justify for another rate increase before end of the year. Remember, when we were looking at the Fed watch and we were looking at the rates a few months ago, they were looking at actually rate cuts by end of the year. So this was a surprise. And that shows the resiliency of the markets or the economy at this time with the employment and also even the GDP. They're feeling confident about that. The other thing we will review this week is quite a few central banks have had either no increases or they've had last increases. And even Central Bank of Brazil had a second rate cut. So we got to pay attention to central banks around the globe, what they're doing. Of course, also the central bankers will start, the quiet time is over, so they will come the quiet period. So they are going to start speaking like this week, coming week, Fed Chairman Powell will be speaking. The other thing I want to pay attention is the seasonality. We've been talking about September. Been talking about, it is the worst month in the past 100 years. So pay attention to that, and also the sentiment. That's the lesson of the week. We look at how the sentiment of the market is, and the market participant, I should say. And as a matter of fact, it's interesting, the third week of September, which we just passed, historically is the worst week. It was not the worst week this year, but it was one of the worst. So we will review that. So again, preparation. We talk about markets. I've said it before. When you look at the markets, don't just look at, just the technical analysis, just the fundamental analysis. There's seasonality, there's sentiment, there's cycles. So they all come together. So if you have knowledge of all of these, the odds are that it makes you a much better investor and trader. Also be aware that next week is end of the quarter. Now the question is, will have the usual window dressing, or will we have more sell-offs to come back in October, which I believe October's are transitional months. So one recommendation I would make, again, in our first 5 minutes, this is the month that you should have, if you believe, again, in the seasonality, you believe the strong month of November and December are coming, this is a good time to start getting your shopping list. So October would be a good opportunity. And would we have rotation, for instance, going from the big cap, mega cap growth stocks, which is the next one item that I will discuss? Will they sell off, and then would we find some values in some other sectors So that brings me to this. I mean, it was not a fun week to be a market participant. So the bonds are really in a downtrend. So, but we have not had capitulation in the bonds. Now, the volume was not that strong. So what if that happens? And with that sell-off, obviously that will put a liquidity crunch. And what happens when there's a liquidity crunch? Then we end up having to force to sell other assets, and some what assets will be sold first? Well, the ones that we are average up 40, 50, 100%. And that brings me to the FANG, which is, Facebook or Meta and Apple and Amazon and the net and Nvidia and Google and Microsoft of the world. Now, what happens if they start getting sell-off? So those are the ones, if you recall, been the big portion of the gains that we've had this year. So those are the things that kind of concerns me. So I want to share those with you. Now, on the other hand, would they go low enough that the bargain hunters might come in? But this is something that I would be cautious about. I would watch this week. We might have a little bounce, let's say Monday. Where do we go from there? As I mentioned, I said it the first week of September, our first meeting, I said I would be on the sideline. I would not be a hero and go on bargain hunt at that time. I would watch, and especially against seasonality. The other things that we will discuss, and you shall see, technically, we have a lot of breakdowns. So pay attention to that, whether it's from the patterns, from the classical technical analysis, whether we see that the market has kind of broken down. So we will look at that. The last but not least, it's interesting that everything comes, fundamentals and technicals come together with seasonality. Will this government shutdown, again, a few weeks ago and 2 months ago, I think I had mentioned this, that what happens if there's a government shutdown, how the markets react. So in the lesson of the week, we go back in the history and look at what has happened when there are government shutdowns. Besides that, of course, again, if you're looking for excuses, we have the auto workers, the United Auto Workers strike, especially with GM. How does that affect? And then we talked about the wage inflation. We have the Guilders Riders, negotiations. The good news is, I think overnight we had Australia, the strikes there negotiating with Chevron. They have come to conclusion. So that labor issue is kind of resolved. But these are the things we have to pay attention. So when we put everything together, you can see why last week and I would say this week are important weeks. So with that in mind, I would like to move on, and we start with the economy. Again, under the hood, we look at the unemployment numbers. They still look strong if compared to 2019. That's what the initial jobless claims, that's what the again, Fed is watching. The other thing is, again, market activities. And with that in mind, we can look at, for instance, the global commercial flight. So you can compare it for the past 5 years where we are now. So we see we are stronger than obviously past 3 years, but also compared to 2019, we are ahead of that. The same thing, we are in line with where we were in 2019. So just a food for thought as far as the activities globally and internally and domestically, So next week, what we look at, there's not a lot going on. There's a few things. We look at the German, which is important, their CPI numbers to see how the guidelines will be for Europe. Spanish CPI, they've been doing much better. And then this is the final GDP. It's important to see again how the Fed is going to react. Again, we won't have another Fed meeting for another, I believe, 6 weeks. So they will watch this, and then Chairman Powell will speak at 4 p.m., which is like 1 p.m. West Coast time. And then on Friday, we have this core PCE price index, which we will like to watch. And then we have the Canadian GDP month over month. The yield, again, the spread was actually at 100 basis point. We're coming down. Still, you can see negative. I mean, you can see inverted yield curve, but you see the long end is higher than the short end, and basically when you compare it to a year ago where we were, there's a little movement. So we will discuss that a little more. So what kind of a week we had? Well, again, I mentioned last week, technically things were in crucial points, and I think we got a little more clarity this week about that. As a whole, the Dow was the least of the worries. They did drop 1.9%. It's the Nasdaq, which dropped 3.6%, and then S&P right in between, about 2.9, almost 3%. As a whole, all the markets, they dropped 3%. And once you see it, almost everything was in that area, 3 to 4%. And you're getting a breakdown in the small caps, as you can see, close to 4%. So there is that concern. When we come to sentiment, we will discuss it in the lesson again. I want you to pay attention to these things because sentiment also matters. You see now there's a little fear that we are lower as far as the bulls concerned, and the bears are getting stronger compared to next week. Again, more fundamental concerns. It's interesting. The fundamentals have been there, but it's all about the feelings, in the sense that if you want to be in those big cap stocks at any price, you want to be in there. But right now we are above the average on the bears. We are actually higher number of bears. The neutrals have moved back from last week, but we're still ahead. And then the bulls have dropped compared to the averages. So we will discuss this a little further. Also, you can see this the CNN Fear and Greed Index. Again, a month ago, we were neutral, but what happened was actually beginning of August, end of July, we were in, if you recall, we almost in extreme greed, and we will, it will come all together. But remember, end of July, this was right here. Now there is a little fear coming, and that's what I think. Oh, would this justify that we might have a little bounce? I don't know, because there's a few other factors, but we take those into consideration. Also, something that we have not used maybe once or twice in the past. This is the bulls versus bears. These bears. It's a survey of newsletter writers, which is a contrarian. And it's published by Investors Intelligence. So we can see the movement of the bulls, where they are now and where the bears are now. So you can see, again, we go back beginning of August, end of July, to see there's a huge gap in between. So we'll look at that. So let's go to the charts and look at where we are. And I mentioned last week, we are those round numbers, 4,600, 4,500. And basically what is happening, I said, watch for we've had a bounce of the last year's, the August highs, and look where we are now. We bounced once and we just breaking below that. So it's still not completely confirmed, but that tells you, I mean, the Friday's candle and the Thursday's, Wednesday's candle, Thursday's candle, that was, they were pretty big. So we want to pay attention. We broke below the moving averages, especially last week. We talked about that 50-day moving average, and look at the volume. Also remember, again, last Friday we had the rolls, and those also make the markets with the triple witching and everything else coming all together. The other thing is, you're looking at the squeeze. Now you can see the LRC has basically slope is down. We broke below the 20-day, 21-day moving average. Now, we pay attention to, again, the color had changed as far as the momentum goes on the squeeze, and now we are in the red. Also, the C wave changed the color right around here, and basically A wave has gone to negative. So although we are in the 2 standard deviation, there might be some adjustments with the LRC. So the idea would be we could have a little bounce. In the meantime, is it possible that the LRC slopes become steeper to justify for the momentum change? That's what I think this week is important. Now, the trend is down because we are below the 21-day moving average. So it is not a time to be as, go long for a, as a swing trader. Might be, again, a bounce maybe Monday. I'm not sure, but that's just a food for thought. The other thing we mentioned last week, again, if you look at the charts last week, I showed you this wedge developing, and I said we got to hold this, and guess what? We didn't. So that's another negative thing. As a matter of fact, if you look at from the chart point of view, this is almost like another very clean head and shoulder, which we just broke down. And now we have 2 candles below this, support line, this trend line. So that's another, again, negative. Is it possible that SPY can go down to 420 or, 4,200? So those are not good news. When we look at from the Bollinger Bands, we are outside the Bollinger Band, but we are broken below 100-day moving average. We talked about last week, the momentum was down, and now we are in oversold, but we are not embedded yet, but we could be this Monday, could we get embedded? We talked about MACD indecision, and now that also trend has changed. When we look at on a weekly basis, you see now the support of 100 weekly moving average is coming to the picture. I talked about 4,200, well, it's at 41.99. Again, on a weekly basis, we have broken down. Basically, the momentum is down. We are not even oversold yet. So basically, the momentum is down. MACD has changed. The trend is down. So basically, watching that. When we look at NASDAQ, the similar story. These are pretty identical. We broke below the 100-day moving average. So again, watch those big cap stocks. And when we look at weekly, again, you see we broke below the 18-week, the momentum down, MACD crossed, and now are we looking at the next would be the bottom of the Bollinger Band, the lower, or the 100-week moving average. And next is the Russell. Now, Russell has been the weakest of those. I think now we are negative for the year. And this is much cleaner. You can see the head and shoulder. And once we calculate from the shoulder, the head, then once we broke down from the trend line, well, now we can go actually to 170. We're at 176, easily below that, below 170. So that's broken down. We had talked about last week, we could not break through the 18 and 100-day moving average. So now Bollinger Bands are expanding. We are embedded. MACD is down. So, and then you can see Bollinger Bands expanding. So, these are not pretty pictures. On a weekly, we've been below 100 weekly moving average for quite some time, since actually April of last year. So here we're touching the Bollinger Band. So we might go outside and then come back in, or the Bollinger Band could actually expand. So we are oversold. So on a weekly basis, so we might have a little bounce, but that's not a long-term buy either. Dow is a similar story, broken down. They're very similar, all of these. Transportation. Last week I said, please watch the transportation will guide us. They have been very weak. And here we are. We have broken down since August under 18-day moving average. And we've been keeping it very orderly. And we watched last week, I said, watch the 100-day moving average, and we just broke through that. And we're becoming embedded. So that doesn't bode well. When we look at a weekly side now, the only thing is, Xavier, might be that 100-week moving average might be a little support. But again, the momentum guide us. So the momentum is down. Again, we are not oversold, and MACD has crossed. As far as the VIX, we talked about last week, we said, VIX being so low, and actually we can see a little divergence here. We were oversold. Now we are overbought. So as I mentioned, we might have a little bounce on Monday. I don't know, but it looks like, the momentum has shifted with VIX, and, we can move from where we are. It is possible to go to 22, 26, even 30 if things really go bad. And at least perception of, government shutdown. And if this government shutdown is, again, it's about being have a fame for 15 minutes. It's nothing to do with principles most of the time. So, but anyway, we will visit that. And then what we could see, we talked last week, we said, even it's not a good time for credit, playing options, credit options, selling options. This is a good time to actually be the buyer of the volatility in a sense, and the premiums are lower. And it would have been a good week, let's say, if you bought put options, or you put debit put options, verticals, debit verticals, put side, it would have paid off pretty nicely. And then volatility of VIX is a crucial point. We're in that 100-day moving average. We are overbought. So, but the MACD has crossed, so we might juggle. We went outside the Bollinger Band, come inside, but that could expand depending on what happens this week. The other thing is that 10-year note. This is the highest we've hit since 2007, in 16 years. We have not seen these yields or the mortgage rates. Now we're becoming embedded. And what that tells us, again, you can see we went outside the Bollinger Band, came inside, but there's expansion, and the Bollinger Bands are opening up. So it is not pretty. And obviously interest rates are what guide the markets. And similar, the opposite way is the 10-year note. We are embedded. We did go outside Bollinger Band, came back inside on Friday, but again, Bollinger Bands are now expanding. So MACD is negative. That's the key. So what happens is this going to be a gradual drip selling up the bonds? That the markets need buyers. There are no buyers coming in, and basically this is what we have to look at. The US government needs funding, and all the other governments around the globe, they have their own problems. So what is happening? They have to increase the rate to attract demand. So that's why I put down, would we see continuation of bond selling? The same thing, again, you see very similar to the 10-year and the 30-year bond. The dollar has been strong. You can see once we hit that zone of, I mentioned about 100, once we hit the Bollinger Band, came back up, it has been steady going up. Obviously, the higher rates also help, and we are embedded. We hit the Bollinger Band, came down. MACD is getting flat, but still, it's still positive. We might need a little rest, but being this high, that doesn't help the markets either. And then the euro is the opposite, hit the Bollinger Bands, came back up. Now we're still embedded and oversold. And then gold was interesting, with all the numbers. It's been talked about last week. it's not seasonality wise, it's not the best of time, but it has been holding well. As I mentioned, the best environment for gold would be stagflation. When there is a recession with the inflation, it will work very well, but we are not there yet. As I mentioned, higher rates are not good for gold. So, but they're being very resilient when you think about it. We look at this dollar being strong and interest rates are being high, it's still holding up well. So there's still demand. It's not a long, but it has been holding well. We are under the 100-day, and you can see on a weekly basis, we're just holding. I think it's more of a technical. We're holding that 100-week moving average, and we just moved to oversold. And silver had a really nice move. They moved up, but they are still under the 100-day. Momentum is up, so that was a nice move from last week. And then when we look at copper, no man's zone. I mean, I wouldn't do anything at this time, and it's pretty flat. And then Bitcoin had a little nice move, but we are heavy resistance at the 100-day moving average, at a 100-week moving average. It's overbought, so just the momentum is just moving down now. So there's a lot not going on, although we are just holding on that 18-day moving average. So crude oil has been the story. As you can see, there's a lot of, I mentioned, manipulation going on with the crude oil. Saudi Arabia would love to have $100 Brent, which is about 95 now. Russia loves the idea, so there's a lot of backhand going on. Technically, we just went to overbought, and MACD is crossing, so we might need a little relief, at least come to the 18-day. But it has been, strong, and it's helping obviously the exporting countries and hurting the importing countries. So that's that. And on a weekly basis, you see we are expanding on Bollinger Band, and basically we're just hugging that Bollinger Band. We are embedded. So that's that. As far as expected move, last week we were looking at about $60 expected move. Guess what happened with all those movements? This was like a 2 standard deviation. We not only didn't hold, and we've talked about, I said before, every time we've seen a move outside these expected moves, which are supposed to keep you 68% of the time inside the range, that tells us that expansion of volatility, something big is going to happen. And last week was one. Now this week is going to be $83 for whatever reason. It's more so than last week, of course, because of the volatility. You see the QQQ, the same thing outside, almost a 2 standard deviation. Russell, big move. We look at Dow, big move. Dollar stayed within, and so did gold. And silver just parked right on the upper expected move. And then the financials, another problem. So one of the problems, especially with the regional banks, when we look at the regional index, when you get a 3-month bill, the government is the interest that they're paying over 5%. Why would I want to go invest in a 1-year or 2-year CD? So there's a competition between the banks and the government at this time. So you see that was again, higher interest rate did not help the banks. And it was interesting that energy actually, the stock actually came down, but they've had a really nice run, as you can see. Basically, they're part of the stock market. Remember that. All right. So emerging markets, basically, this is as of Wednesday. You see, actually, they were quite, as of Wednesday, this is before FOMC, we had a lot of positiveness. Year to date, we did have some just starting to see negative, but overall, again, for the year to date, there are a lot of strength overseas. But the last 2 months, when we look at all the international ETFs, what you see is, again, we're using the 50-day moving average and 20-day moving average as our barometer or our trend recognizer. We see this, I mean, that's why I want to use 2 months, because even 2 weaker months, but September being the weakest, you see that's almost everything. Again, India even went down, but we are above the 50. Almost majority of the international funds are under. Of course, the dollar is being strong. So let's talk about interest rates. Few things happened last week. So the Swiss National Bank ended its run of 5 consecutive interest rate increases since it started lifting in, which was in the negative territory, remember, in June of 2022. So they like to keep the rate at 1.75, although the SNB noted that inflation has ebbed lower, but said a further tightening cannot be ruled out. And this was the same language with the European Central Bank. Turkey, on the other hand, as you recall, President Erdogan, for some reason, thought by reducing rates, he's going to bring the inflation down. So, but now that they have a new central banker, we have had big raises, and now they raised it by 500 basis points to 30%, which is a 20-year high. Monthly inflation rose by more than 9 percentage points in each of the last 2 months, and it could surpass 65% by end of the year. Also, Egypt actually kept its key interest rates unchanged, and that happened few other places. Like we talked about Switzerland, mentioned Brazil brought it down. So it held on its overnight deposit rates and lending rate at the rate of 19.25 and 20.25 and 19.75. So they held it, but it's interesting to look at Egypt's the urban consumer price. You see the headline, but look at the food and necessities. You can see huge. I mean, food, especially when we think about like wheat, plays a huge role. And then also alcohol and tobacco. Look at the increase since 2022. So just food for thought of how the inflation is rampant. We're looking at over 70%. Switching gears, going to the geopolitical, we cannot have emerging markets without discussing geopolitical. The influence of China. I mean, I've said the difference between the Western, I don't want to say colonization, but the influence, we give aids, we give money to all the countries, generally with no accountability. Well, China goes, whether it's in Africa or Central Asia or Middle East or like Latin America, especially you think about Venezuela, they go and they actually participate. They start investing there with them. They give them loans, but they keep them accountable. But they usually do that. So it was interesting to see that Bashar al-Assad, Syria's president, which he's, when the whole thing, the civil war happened in 2011, his length of as far as his survival was like in months, but here we are 12 years later, he's still there. He arrived in China. This is the first visit since the start of the civil war, and is expected to seek Chinese funds to help rebuild Syria, ravaged by over a decade of conflict. Mr. Assad and international pariah since the war recently established relations with several countries, and in May, Syria was readmitted into the Arab League. So this is about survival and staying as long as you can. So here he is, and you remember now our world has become, Russia and China in one end, their allies, and then we have the Western world. So that's how the things are working, and each one has its own basically policy and philosophy. Now, on the other hand, Kenya, being ex-British colony, and we're close to the Western world now, Kenya will strengthen cooperation with China on intelligence sharing and security, the country's interior minister said. So he was speaking at the Global Public Security Cooperation Forum, and said that China could help Kenya in the fight against terrorism, cyber attacks, and climate change related insecurity, which is really interesting. But anyway, so they are looking for bilateral and multilateral security partners. Switching gears again, we talked about oil and what is happening. And I mentioned last week, strategic reserves. We could have bought them at the 60, 65. The government could have filled the strategic reserve, but they didn't. But anyway, so when you look at the rig counts, which is the refiners, the oil refiners in the United States, for instance, on Friday at 10 a.m. it comes out. You see from previous week, we are down actually 11. So really the supply is going down. Change from last year is 134, whether it's the maintenance or, again, I mentioned, why would they want to invest in their oil rigs and other things if there's this big push against them? Obviously, there's the clean energy and alternative energy, and the government is not friendly. We warned a year ago this could happen. Look, this is 134 negative. Canada is negative 25. So basically, this is something that you want to pay attention as far as the price of oil. Switching gears, South Korea is an important force in Asian economy, and I would say in the world. So they just had election 2022, and President Moon is President Yoon does not have a control of the parliament, and you see how fragmented the assembly is. So, right, talking about switching gears again. This was interesting. We had the Olympics in Japan last year, and then we have in Paris coming up next year, but we have Asian Games starting in Eastern China. And it is the first, after the COVID-19 delayed it. So the games are bigger than ever. 45 countries and 12,400 athletes will compete, more than at the Tokyo Olympics in 2022. What is interesting, this is what I want to share with you, is the event will also be the first of its size to feature esports or competitive video gaming. Gamers will compete in 7 events, including popular games such as FIFA Online 4. That should make my son happy. A football favorite, and the League of Legends, an online fantasy epic. So International Olympic has been, has had concerns, obviously, because of violence in video games. But here it is. This is officially becoming a part of Olympics. So I hope that's just, again, going all over, but I hope that was helpful. And let's talk about, I think I would pay attention to this segment, lessons. Hopefully this will be informative and helpful. Now, after obviously Wednesday's, no movement, and the markets again had that participated. Now, what I want to look at, I don't want to look at the November's, but actually December, because what the market is looking at, whether there will be an increase. So now, as of Friday, actually, the market is anticipating about 38.4% increase of 25 basis point, or 6.7% of the 50 basis points. So right now, there's a 54.8% that there won't be any change, but 45.2% there will be a hike. Now, when we look at a month ago, there was about 37% chance that there will be a hike. And a week ago, it was about 39%. So you can see how the language of the Fed changed the things. So this is what we are looking at the Fed Watch. going back to the interest rates, I mentioned to you, this is a 16-year high. As you can see, this is a monthly 10-year rates, and this is where we were in 2007. Now, is this where we are going? So this is a food for thought. I mean, there's the path of least resistance looks like that. So, but we've had this parabolic movement. Obviously, we had 11 rate hikes. So, just saying, just watch that. Talking about sentiments, as I mentioned, there's those 5 forces that I talked about. Please pay attention to these. You cannot just be a chartist, or cannot be just fundamentalist. And that's our goal with our classes, to really make you familiar with the older relationships. I mentioned to you what happened, the extremes on the American Association of Individual Investors. Now, what we had last year, end of September, actually exactly a year ago, September 28th, this was the highest reading of 60.8% bearish. So what happened to the markets? First of all, we actually, this is our 200-week moving average. We held it, and we had really, if you go back to October, that was the lows that we put in, and look at the movement from then to where? To where we got it at American Association of Individual Investors, the highest reading of 51.4% bullish. And where was that? That was right toward end of July, July 19th. And then exactly a week later, we put the high, and this is what has happened. So, I mean, this is visually just tells you why you need to pay attention to these things. And obviously, you can see now we have the 100 weekly moving average, as I mentioned, is coming up. So we pay attention to that. The other thing I want to pay attention is I usually look at the number of percentage of stocks that they are over their 200-day moving average. So usually we see the extremes. When we have, again, last year in October, this would have been a good guidelines to say that, you know, really oversold. I mean, that's only 11.4% of S&P 500 are above 200. And then this is in July, again, July 19, we had 76%. So we are at 43%. So I would be watching that. And so what we need to see there is, again, the bottoming. And so this is something you can look at, actually the 50-day as well. So this symbol, you can go to stock charts and you can see it there. So last week, let's see what happened. You know, again, it was not a pretty week, but the stronger of all the sectors are all down. But you see the defensive stocks, such as consumer defense, energy, healthcare, and utilities, they fared much better than the cyclicals, real estate, and basic material. And this is what I mentioned. You can see, obviously, we do have these defensive sectors are all down. I mean, energy finally is coming up. I mean, for the month is the only positive besides the financials. But you have these big winners, such as communication services and technology. What happens if there is a little panic, and would the money move out, and we will have sector rotation? So, food for thought. The other thing I want to pay attention is we talked about the consumer discretionary, and that's one of the things we look at, the defensive and the discretionary. When you look at this chart, as you can see, this is a long-term trend from the beginning of the year, and we just broke below that. Now, does that mean we will go down? And remember, what is in discretionary? Select discretionary. You know, we got the Amazons of the world, we got Teslas of the world. So pay attention to that. On top of that, so that's the consumer's behavior. If the consumers lose faith, what will happen to the economy, and also obviously to the markets? The same thing, we look at the home construction, that is XHB, but ITB is, in my opinion, better. It's pure construction rather than XHB has like Home Depot and Lowe's and other things, housing related. But look at this. Again, another breakdown. We had a wedge. We talked about how the wedge is working. And then, when we look at basically this wedge, I mean, the distance from there to here, it's still got a ways to go. So again, technicals. Another lesson, this is a chart of soybean. Now, what is happening with the soybean and also the other agriculture like grains such as corn and wheat, it's quiet time. Corn and wheat, you have to remember, it's the harvesting time. What has happened, just purely I'm watching again, when the harvest comes, the prices usually drop because now we got the supply. On top of that, what we do, we can take advantage of exporting. So there should be a demand. The problem is this, and I'm looking at soy, the same thing we can look at like wheat, but let's say soy, from fundamental point of view, is with a strong dollar, would the overseas markets want to buy our soy, or would they want to go to Brazil and other places? The second part is the high cost of transportation. So with the crude oil being at the price that is now, would that make sense for the transportation, so the higher cost? So that's the reason you can see the markets have come down. The only thing is we are getting very embedded. We are on that 100-day moving average. So we'll see if there will be a technical bounce. But I just want to explain why we've had this. Again, it coincides with, again, the higher energy prices as well. And I think that some of you, if you've been in the business for more than 25 years, you could remember, I know exactly where I was this happened. I know exactly where I was when the Asian contagion happened with the Malaysian ringgit and Thai baht. When that happened, the currency in Asia, and a year later here was the 25 years since the long-term capital management completed one of the most spectacular falls from grace in Wall Street history. Now, they were the hottest hedge fund in the mid-1990s. They had two Nobel laureates and superstar team of bond traders. And of course, they heavily bet on Russia, and they were from Salomon Brothers. And between 1994 and 1997, they returned 30% a year and never lost money 2 months in a row. So here's 1998, and they are they were making big bets, and then they lost 90%. I just purely remember how the markets reacted, and immediately New York Fed Reserves urging the Wall Street banks arranged a $3.6 billion bailout. And obviously they were favoring, they thought they wanted to save it so it won't have a contagion again. And that's done. The Fed's involvement raised eyebrows whether hedge fund ought to have been treated too big to fail, which we know how that happened. The rest is history with the what happened in the financial crisis, also with the involvement of the government. But this was a hedge fund, so that is by its name. And so one lesson I will share with you is they were very successful. They really did not need to make this big bet. So the fall of just more of a, I would say, life lesson. The fall was they didn't think things were good enough or they had enough. They wanted more. You see somebody makes 100 million, wants to make 1 billion. In my opinion, whether I have 10 million, 100, or 1 billion, I mean, personally, that doesn't make much difference in my personal life, unless, I want to really help others, which is fine. But this is all about this is hedge fund, but I would protect this. Risk management is the most important thing, which majority of people really put aside, including when we think about two Nobel laureates. And this was a huge fund, and here it is. So I just thought this is a good lesson on anniversary, which is today. Another lesson it was asked, it's about free cash flow. It's important to understand that it's the cash that a company produces through operations less the cost of the expenditure on those assets. So the free cash flow is cash left over after a company pays for its operating expenses, the capital expenditure, which we call it CapEx. I really like the free cash flow when I look at analyzing the companies, because generally you cannot manipulate that like earnings. There's no non-cash, or it's more of a accounting gimmicks in there. So it excludes the non-cash expenses of the income statement, includes spending on equipment and assets, as well as change the WACC, or the working capital, from the balance sheet. So it is something that I encourage you to pay attention. It allows a company to pursue opportunities because really they have the choice, especially when we have like this high interest rate environment. So it is important to part of your analysis. I would definitely encourage you, and that will help the shareholders value. All right, so let's a couple of things with the unemployment, what we are today and what to expect. Historically, the worst time to buy stocks is when unemployment is low of less than 4% and rising. This is the current situation. Now, we haven't really risen, but it is something to look at. So you can see the market's expected to make under 4% if this is the environment that unemployment all of a sudden start rising. The best environment is the worst case scenario, in the sense that when we have high unemployment, so all the bad news is out, so it cannot go any worse, I guess. So that looks good. This is another thing I want to share. My apologies for it might not be as clear, but this is what happens when there's a government shutdown versus S&P returns. Historically, government shutdowns have not had a significant impact on the US stock market. So basically, the environment we are in today is we had this situation under President Obama, with the Senate being Democrat and then the House being Republican. And look what happened to the markets. S&P was up 13.1%. That was for 17 days from October 1st, which we will have the same thing, till October 17th. And after that, the return 12 months after, the markets were up 8.9%. So just saying. So you can see the average shutdown is 9.5 days. And the S&P actually, it's when we look at cumulative, it's 57.1% percent of time, 57.1% higher, and 85.7% of the time is higher. So just saying. Trade of the week, again, we're looking at the gap. This might get filled. This is not everything else was filled. You can see this gap was filled, and then that gap was filled. This was when the FOMC came. This is our 1. This is our 2. That's when Powell started speaking, and then boom. So this would have been a good, maybe you could have gotten in here with our 1, 2, 3 and make some money. Other thing is, as always, I do my gold play. I was, again, with all the news, I was very conservative. So I just wanted to share with you, my timing was not the best. I got in at not the right place, but I hit my first target the next day on Friday. So at the end of the day, I think, my 4 contracts were down like $30 or so. I think I lost like $10 or $15. So it was a very small amount, but I was at the money in gold trade. So this was kind of a wash. But the reason I share that is options, just pay attention to the theta. So if we use our philosophy of buy on Thursday and sell on Friday, that would have worked. I mean, we were up almost over $1 from Thursday to Friday on a 60-minute. But options, they actually have the theta. So although I was right, as far as, even if I got it at the wrong time, I still was up. But the question is, as the day went by, my theta is depleting. The other thing is also, really, I don't go aggressive because although the 60 minutes was telling us we are going to be up, and it worked. But I didn't have a lot of conviction on a 30 minutes. You can see we were in the lower end of the cloud, and it still did go up, but the cloud had the higher slope. But it was not completely convincing. And even, on the 10 minutes, we still just stayed inside the cloud. So that's why I wasn't aggressive. But, these are things, again, hopefully that's helpful. ETF of the week, well, again, energy and MLP, Master Limited Partnerships, MLPA was the big winner, 2%. The loser was a PBW, the Clean Energy ETF. Uranium was up 1.4%, and ARK Innovation was down 7.7%. On purpose, I don't have the stock of the week. There is nothing really to talk about. I don't want to spend your time looking for buying stock this week. I'd rather you have a shopping list. Just be ready for next 4 or 5 weeks. That's my recommendation. There's could be some bargains, but right now there's no reason. This is a time to focus on the markets. This is the time to see what S&P and Russell and NASDAQ and the interest rates, what they're going to do. As far as it squeeze, NASDAQ 100, these are some actually nice setup. They are in a squeeze. They could be on the downside. So watch that. I mean, it doesn't have to be all going up. So, but they are some big names in the squeeze. We still got earnings coming up. So basically, pay attention to that. We got some good names coming up, such as Costco. We got Carnival Cruise, Nike. We got Micron. We got Accenture, CarMax. I would be interested in seeing that. So, and then Cintas. So with that in mind, I hope that was helpful. I think it is a crucial month. I hope, or week, and it was end of the month and end of the quarter. So with that in mind, I'm gonna stop the recording and open up for Q&A. Thank you so much.